Our market master of the day is Rajat Rajgaria. He's Managing Director and CEO, Institutional Equities at Motilal Oswal Financial Services. He's now joining us for the Motilal Oswal big conference curtain raiser. The conference, of course, is set to kick off starting Monday. Rajat, great to have you with us here. Thank you very much. Good morning. During the conference and post the conference, we can get a sense of the feedback that you're getting from corporates who are attending. But before the conference, I can probably begin by asking you, what's the level of enthusiasm right now? And that we can gauge from the registrations we are seeing. This is also one of the first kind of completely COVID-free conferences in a while. So how are things looking, Rajat?
Good morning, Prashant. Good morning, everyone. Very pleased to be back here on the curtain raiser for our 18th annual investor conference. And Prashant, you rightly mentioned, we are doing this physical format after a break of 2 years. We have almost 170 companies, the who's and who's of corporate India across sectors. Our celebrated CEO track, which features almost 15 plus CEOs and experts across corporate India and different walks of life, are going to share their views with investors who are assembling from across the globe. We are looking at almost 1,000 plus registration of clients. We are looking at 170 plus corporates. And as we speak, the number of meetings requests continue to pile up. I think this will be an all-time high for us, where we are looking at almost 13 to 14,000 meeting requests that are coming from investors across the globe. So I think even investors are very keen to get back into the physical format of interacting with companies, and we are happy to host them. The coming Monday, Tuesday, Wednesday, the 3 days of the conference should be quite exciting and should open up a lot of investable ideas for our clients.
Rajat, good morning. I guess that's why you're not getting any rooms in Mumbai, in any hotels. So 14,000 meeting requests. Is the FI interest in India at all-time high? And how much of this is pent up? Purely because in the last 2 years, they just could not come here and, meet with corporates, because kind of outperformance that we've seen for Indian market, Rajat, is stunning.
Absolutely, Anuj. In fact, not just the conference, but throughout the last 6 to 8 months, the number of virtual interactions that we have been providing for FIIs with Indian corporates has been almost a new high. And I must say that every week we are seeing some group of FIIs from some country or other who are continuing to visit, where we are hosting their itineraries. But specifically for this conference, I think the number of FIIs from multiple countries that are coming to visit our conference is something that we have not seen earlier. But I must put a caveat here that over the last 3-4 years, we have seen the rising dominance of the domestic investors being very high, and that spread of domestic investors has moved beyond the mutual funds and insurance also. So this time, when I look at the client registration and the meeting request, I must say this is as diversified as I would have ever seen in the 18 years of we hosting this annual event.
Wow, that speaks a lot, right, about the kind of enthusiasm that we're seeing in the market. But I was going through your note, Rajat, and you have done an analysis on how the last decade has panned out for corporate profitability, right? And you speak about how India Inc.'s earnings have multiplied 2.6 times between this FY12 to FY22 period. And there are, of course, many sectors that have taken the lead. But from now, over the next decade, what do you see as the big trend? Which are the sectors that can assume leadership, and where would your preferences lie?
Yeah, so when you look at FY12 to FY22, that same report divides the 10-year into 2 phases. And we know it has not been uniform. In fact, for the first 6, 7, 8 years, the growth was relatively low. I think it is the last 2 years where the growth has picked up, and that has been surprising, because standing in March 2020, we would not have assumed that the growth rate for corporate sector and the markets would have been so high. But I think where we stand today, one can comfortably say that the next 10-year growth rate is going to be better than what we saw in the last 10 years, right? And the 3 primary reasons: your financial sector is in the best of the health than what it was in FY12. you are looking at a big capex cycle which was almost absent during the last decade. And I think third, the emergence of many new industries, be it insurance, be it e-commerce, a lot of them are going to contribute to profit while they were largely contributing to low profit or losses in the last decade. So I think fair to assume that the next 10-year growth rate is going to be good higher compared to the last 10 years. How much we all will be a part of that.
Rajat, just one quick thing, and you'll have the figures, but I remember reading that about 50% of Nifty earnings, right, are dependent one way or the other to global, to the global economy. Correct me if I'm wrong on that. With the globe starting to slow, I mean, it's also the cyclicality of the thing, right? We've had many years of above trend growth, and these are cycles. And of course, I mean, there is a problem at hand, the inflation issue and what central banks are doing, etc. A slowing world, how does that impact earnings potential growth, and does it hurt to what degree if you looked at it?
Right. Prashant, I think that 50% just needs to be divided into two buckets. While IT also may be linked to global economy, it is not as cyclical as what you typically think about the metals, right? There the growth rate may vary in the lower end at about 8 to 10%, higher end 12 to 15%. So I think that is as strong as what your domestic staples are. Secondly, I think Reliance also needs to be bifurcated well between the ONG and the telecom and retail, because they are now a lot more domestic. So I think when you look at last year, FY22, you had the record year for metals, like Tata Steel reported a record profits, and some of the other domestic businesses were still being impacted. So that ratio may look higher for 1 year, but I think amongst the larger economies, we are still the one which are least insulated from the global cyclicality. And for our earnings, I think the global cyclicals would not be more than 15-20%. The rest would either be domestic or would be global, more structural spaces like global IT.
Okay, since you just said global IT, Rajat, are there any big IT companies coming to your conference, and have investors lined up with them? Because that's where the big debate is, right? On Indian IT, which has been leading the market for the last 4 years. And this year we have seen a crunching bear market.
So, Anuj, we have in our CEO track, we have two special sessions on IT. One is being presented by Mr. Harish Mehta, who has been the original founder of NASSCOM. And second, we have a session by Mindtree. So in the track itself, we have two sessions. And in the one-on-one meetings that we are doing of 170 companies, there are mix of both IT companies, IT product, I mean, both IT services, IT products, and number of e-com companies also. So as I mentioned, that the 170 companies has a mix of every sector that one can virtually think of.
In your note, you talk about the top 10 companies of the last decade that were big performers, right? And within that, the most profitable companies include names like Reliance, ONGC, and TCS. In fact, the three of them are the top 5 profit contributors throughout the decade. Do you think the leaders of the last decade will change in the next decade, or could it continue to be the same, which include names like this?
The sheer size of these companies has become so big that even if they keep compounding at 10-12%, their base keeps becoming high. So if you look at the same report, the ranks within the top 5 companies have been changing, but the top 5 have largely been the same, right? I will be surprised if you really see more than 2 or 3 being displaced out of the top 5. Reliance, just because of the sheer investments and what they can do out of these investments, in my view, would remain amongst the top. TCS, again, the profit base is very high and they can keep compounding. I think maybe, you may see 1 or 2 banks like HDFC Bank as a group, when they will get consolidated, may emerge over the next 5-10 years as one of the top 5 companies in terms of profits.
No, I think my question, Rajat, was more about how do you deal with this disruption that we're seeing, right? I mean, 10 years ago, perhaps, if you would have bought a stock and just let it be for 10 years, that would have been fine. But now things have changed. Sectors are evolving by the year, forget about a decade, right? So do you think the same set of sectors, IT, oil and gas, that did well throughout the last decade will continue to do well? That was my question.
So I think IT will definitely do well when you look at beyond the next 12 months. So if you look at next 5 years, 10 years, I think their strength, their dominance will remain. Oil and gas is something which I think is a very difficult view to take, because we are also talking about a lot of disruptions in the global energy basket, right? So I think that is one space that I am still unsure about. I think financials as a basket, you will see rising in ranks, because again, last 10 years, we saw profits being depressed. Next 5 years could be like a very sweet cycle. But again, you need to understand that the profit pools of every sector is not so high to be amongst the top 5 or top 10. Companies may have a very high growth rate, but the absolute profit base will not be very big for them to be in the top 10 or the top 5.
All right, Rajat, it's a pleasure. Thank you very much for joining us, and we'll have lots of interactions with your other team members through the course of the day and through the conference as well. Good luck with that, and hope to hear more from all of you. Thanks very much with that perspective. All right, now.